Thank you very much. Sorry, I'm just trying to start the presentation.
Yeah.
Can you just be a second? You should be able to see my screens shortly.
Let's give it a second.
Anything happening?
Yes, here we are.
Excellent. I was getting worried there for a second.
Yeah, I said tech enthusiast. I didn't say you were brilliant at tech.
That's good. So I'm just going to take you through really what's been happening for the last 12 months within the fintech market. It's been a tough year for everybody. Some real challenges. So overall funding has fallen considerably over the last 12 months. The UK has faced the same challenges that's been faced globally. We've actually the amount of capital that was actually deployed has been reduced by 64%. So there's been significant traction within the market itself. Top deals are still picking up the greatest amounts of capital, and we're seeing a lot of changes within the market as a whole. Some good news, and that good news is that the amount of the adoption of open banking has increased by 30%, and the use of embedded finance within e-com markets, etc., has actually increased to 10 billion over the last 12 months by 50%. So I actually wanted this to be a little bit more interactive. So I just wanted to have everybody off mute and be able to actually just talk through these slides a little bit more.
Yeah, that's great.
If that's okay. So, good news and bad news. Bad news for VCs, great news for founders. We've seen some big firms go under over 2023. Kyoto, Fronted, Pi-mate. From your own perspectives, I mean, what have you been seeing? How many sort of companies within your space have gone?
From my perspective,
yeah.
I mean, what I'm seeing is companies that I know looking for traction. You know, so I was talking to John just a second ago about and Daniel about, you know, it's investment is money, sales is money, and people are taking that approach of actually I'm going to just do both at the same time, and whichever one comes through is I'm going to need investment, but it's becoming something that people are relying on less, and they're looking for other pathways. I've seen lots of companies look for a conversation about research grants from the UK as well, but that's another headache and pathway where it's only appropriate for a certain amount of companies. There's a few that I've seen that have shrunk, one or two that have fallen away. Most are surviving. They just know that it's going to be a delay.
And absolutely, and one of the things that we're seeing is that everybody has had to extend their runway, and a lot of VCs are telling fintechs, all sorts of founders, to extend your runway, and to concentrate on revenue. One of the challenges around that is that in another 12 months, those same VCs will be saying to you, you haven't got enough growth. So although you're seeing organizations focusing on that growth, and you know, some of the key trends over 2024 are predicted to be just that, you know, focus on more lucrative products, this challenging environment, the conditions are hard, you know, your valuations are going to be lower. Good news, by the way, blockchain is going to improve apparently over 2024, but I'm not here to talk about blockchain because I don't understand it and it's not my field. but you're going to run into a wall at some point because the VCs are all about growth. They're not about revenue. They want to see outsized returns. So yes, you do need to concentrate on revenue because that's what the investors in the current landscape are looking for. But you also have to keep an eye for the future to say, hey, we need to make sure that our growth statistics are there, because when the climate changes again, we're going to be in trouble if we haven't done this.
So growth and traction is always going to be part of the conversation then.
Growth and traction, yes, absolutely. Absolutely. But at the moment, the focus, everyone's saying, you need to be revenue generating, concentrate. We're investing into good businesses with strong revenue generation and all the rest of that. But VCs were doing that prior to COVID. It's only in the prior 2 years after COVID where things came out of lockdown and things started going crazy, where it was growth, and they stopped doing their due diligence to the level that they were doing it beforehand. So we haven't actually seen a lot of change over the last 12, 18 months. All we've seen are things going back to pre-COVID type DD and scenarios.
Okay,
so let's crack on. This is all for Simon. You guys are thinking about coming to London, and London's a great place to be. It's the UK is the third largest economy for the startups. There's over $1 trillion in the startup ecosystem, and London is actually the 7th largest deployer of capital in the world. Now, fintech actually is doing even better. Fintech deals in London and the UK, there were over 5 billion worth of capital deployed. That's 409 deals. In Europe, we are ranked number 1 for capital that's been deployed. As you can see from the graph, and we were just talking about this, there was a massive spike when we came out of COVID, but the number of deals are actually being capitalized at the moment are on a par with pre-COVID conditions. If you take out that blip of 2 years, it's actually pretty much the same. There isn't as much as a difference as people think. And London's a great place to actually be in because it's home to disruptors and innovators. One of the things that you have to remember is that VCs invest in outliers. They don't invest in normal businesses or businesses that have had 10 or 15 companies that do the same thing. So you have to make sure that you are disrupting the market, that you are contrarian, to be able to demonstrate that to the VCs for them to actually be interested in deploying capital. So how you do that, obviously, is a conversation that we're going to have further along in the presentation. This is what we're all after, a memo. Somebody to take their time to fill out a 10-page memo about your business and to fight for you in front of an investment committee, whether that's at pre-seed, Series A, Series B. The journey's slightly different, and the information that's required and the things that you have to prove are slightly different. But ultimately, that's the goal of everybody, to get that information filled out by an investment manager and put to that investment committee, and to somebody to rubber stamp that and say yes.
So the fundamentals within that, I say it's different for seed and Series A and Series A plus. What are the core fundamentals? Is it going back to traction and team and vision, or?
So by the time, let's go back to kind of the beginning of the journey. And I know most of you have done this journey already.
Yeah.
So I'm not going to spend too long on this. But at the pre-seed stage, you don't have a business, or there is very little of a business. So the only thing you can really judge the company on is the founding team, whether you have found a market fit, what the products and services are, Is it unique? Are there a lot of competitors? The size of the market analysis. That's all you can really base it on. So you're looking at the founding team's ability to execute. By the time you get to the Series A, that's where your financial projections come in, and your ability to identify the risks to your business. There is a chasm between seed and Series A, where you see a lot of drop off of businesses unable to raise funding, and the reason that they struggle to raise funding is because they don't have enough moats. They can't mitigate the risks against other competitors in the market.
Okay.
And they can't show the growth that's required. Ideally, what are we looking for in fintech? 20% growth, month-on-month growth, 40% margin. That's VC speak for we want you to be making lots of money, and we want to see that curve going up at a steep angle. It doesn't necessarily, that growth doesn't necessarily have to be linear like that, but you have to be able to prove that growth is possible and it's happening. It's all about having that proven market fit. Once you have proven market fit, your business should be growing. At Series A, so at Series B, things really start changing. Again, there's a big drop off between Series A businesses and Series B.
Yeah.
Due diligence becomes a lot more difficult. The roadmap that you have has to be spectacular, and that you've had to have had that proven growth spurt. And quite interestingly as well, from a founder's team perspective, somebody will be calling the people that you have worked with in the past and say, have you worked with this Simon Sprints before? What did you think of him?
Right. Yeah.
And yes, so there are due diligence calls. They will be looking at you to see what you have done in the past, what skills you lack, which is one of the questions I was asked recently of a founder. What were they like to work with? So if you were a person that shouts at your staff all day long, you might want to take some anger management classes. Otherwise, when the DD happens, it's not going to be as much fun for you.
Just carry on. Sticking with the fundamentals for one moment. So, what are the things that? So obviously you work with many companies. What are the things that they kind of get wrong? I'm presuming competition analysis might be one of them, and being clearly aware of the risks to the business when they start going into Series A feel like a common couple. Is that right? Is there anything else?
Yeah, absolutely. It usually comes down to the market analysis,
or lack of it, Marco.
Or lack of it. Yeah.
Oh right. Okay.
So, or even lazy market analysis. You might think that you know all the players, and then one of the things that I often get told, especially by new founders or first-time founders, is we have first mover advantage, and then you have to say, well, yeah, that's great, but I've got 10 pitch decks very similar to yours. Why do you have first mover advantage? And in fintech, there is no such thing as first mover advantage. Yeah. It's a busy space. We all know it's a busy space. However, there are still gaps in the market, and gaps are opening up all the time because companies are failing all the time, which is great for us. We're growing a business. If two of my competitors go out of business, that's more consumers for me to target.
And are new funds appearing because of this? Some more agile funds, or is that just an assumption that we make?
No, so funding wise, it's a really weird time. New and emerging managers, they're struggling to raise follow-on rounds. Okay. There is a lot of talk of zombie VCs. So that's something to be aware of. You could be sending your pitch deck to VCs that potentially do not have the ability to deploy capital, or no longer have capital to deploy. this market at the moment is very much a VC's market. It's an investor's market. What has happened is that the IP market has dried up. So capital that's released from those IPOs goes back to the LPs, who then go, thank you very much. We will now reinvest into the VC market. That's not happening. So you get this trickle-down effect where money is no longer being deployed to VCs, or it's being deployed slowly. Ultimately, it's the tier one VCs that are getting all the capital. The new managers aren't, which then trickles down into us, the founders. It means that VCs have a lot of dry powder. There is a lot of dry powder in the market, but there is no easy way to replenish that dry powder once it's gone. So as a VC, I'm going to take my time deploying my capital to make sure that I'm getting the most value that I can from each investment.
Yeah.
From a founder's perspective, that's bad news, because I'm running out of runway, and at some point I'm going to have to take a bad deal because I need that capital. So if you haven't started your fundraising journey yet, you should be doing it. Unfortunately, it's about 70% of your time, but as the leaders of startups, that's that are going down the venture route. That's the price that you have to pay to be able to raise successfully.
Hi, Hassan. You've got a question.
Yes. Hello, Simon, and hello, Marco.
Hi.
I haven't introduced myself previously. Actually, this is my first time in the group. I don't know if there are any previous discussions prior to this one, but I wonder, Marco, your statistics are about M&A and VC deals. I mean, those paths are more well established, but maybe we would like to know each other's stage. I would like to know more about the seed stage, if there are any statistics about that, or what would be a good match for a seed stage company, let's say. By the way, I'm Hassan from Istanbul. I'm the CTO of a company here, and we are having initiatives in seed stage investment. I mean, pre-seed investment is there, as well as a government grant from National Research Institute is there. So we are now in the seed stage. The product is ready. And what I would like to hear more about seed stage match. Yeah.
I think, Hassan, that there's one thing for me, which is from your perspective, what amount of finance is seed stage for you as a Turkish company?
There are some legalities going on currently, but after we settle up for the seed stage legalities, all the papers, we will have the company set up here, and we have debuted a few months ago. Yeah. And so we have pretty much prospects here, like 10 real sector companies, one creditor abroad, actually, that is looking for some customization on our product, which is pretty viable for the creditor landscape as well. It's a platform, by the way. I haven't mentioned about the product.
Yeah. I suppose the question is, how much money are you looking for at seed stage?
Sorry, I haven't.
Yeah, it's okay, Hassan.
Hear that well. For seed stage, I think the range is pretty much, how to say, determined in the industry already. But before Series A, for Series A, it should be a little bit well established for revenue and customer metrics. I mean, I have that much of users, or I have that much of revenue, then you might be looking for some Series A. But before that, the range is somewhat limited. I cannot tell a direct number because the industry is sitting there already.
At seed stage, this is all about context. And Simon and myself were having this conversation the other day. Depending on who you are, how you're doing, will drive
Indeed
how much capital you can actually raise. So let's go back to kind of that pre-seed, first time raising funds. If you have no track record as a founder, as in this is your first business, Depending on where you are, if you've got a live product, you might be able to raise 200k, 800k if you've got a live product, up to 1 million if the product is live and it's being used by people. As you go up the rankings, you've got some experience within business, that number increases again. With a live product, 300 to 800k is possible. If you're a senior person, you've worked in a role for 20 years, you worked at the British Business Bank for 20 years, you've got all the connections that you need, you've got some real in-depth knowledge and knowledge that isn't publicly available. You could raise between 1 and 3 million. It's all about context. If you are a brand new graduate out of Oxford University, would I give you 1 million? Probably not. Would I potentially give you 250k? Yeah, if you've got the right idea, the right team backing you, I don't see 250k being a big issue. If you're Sam Altman and you came to me for a raise, I'd be saying, how much would you like? Sam Altman raised 85 million at pre. It is all about context and what you can prove and what you've experienced in the past. Exited founders that have exited at 400 million will raise considerably more than that Oxford graduate.
It's also about risk, isn't it? And about how much money you choose to take up front, because ultimately at some stage you're going to have to demonstrate that there is a return on that initial investment.
Yeah, absolutely. I mean, and this is one of the questions that's always asked, whether you're at pre or Series A or Series B, is what's your exit look like? How do we get the return on our investment? And ultimately, VCs, they're not afraid of a risk, but they don't give their money away. And there is a checklist that many VCs use to say, hey, are these the right people? How do we mitigate the risk of our investment? What can these people prove to show that they are a good bet? It's quite interesting. Mark Andreessen from A16Z, he talks about investing in businesses that show strengths, not lack of weaknesses. So you don't have to be the perfect business, but you do have to have those strengths that will demonstrate that you can grow, and that's one of the things that they really focus on at any time.
By the way, Marco, I'd like to add something. The amount of investment was question of Simon's. So let me get back to my question first in that regard. What would be a good match for a seed stage company to look for? I mean, VCs are not much interested in earlier stages, startups or initiatives in that regard. So micro VCs or some accelerators might be interested in that.
So absolutely. So
we go for it.
So the way to actually think about this is VCs are looking for fund returners. Usually they promise 3x returns to their LPs, so they need two, power law, and I'm sure you're all familiar with power law, so I'm not going to spend too much time going through that particular piece. But power law says I make 20 investments, 2 of them will return my fund. So depending on the size of the fund, and which is why I was talking about exits earlier on, is if I believe I can take my business to 400 million pounds, I'm going to give away X amount of equity. You do your maths on your spreadsheet, and if somebody gets 20% of my business at pre, 20% of my business at seed, my Series A investor gets another 20. What does that look like? What returns do they get if I exit at 400 million? Now, then you're looking at funds that you can actually return the entirety of the funds for. So at the smaller stage, micro VCs, 50 million pounds fund. If you're exiting at 400 million, 10 to 50 million fund, you can return the entirety of that fund. Fantastic. You go to a fund that has 250 million under management, all of a sudden they're going to go, you're not going to be big enough for us. So you have to do your maths. And it is all about those financial projections. I hope that answers that question. Any other questions?
It is. Thank you, Marco.
Simon, you about 5 minutes ago, you asked about what are the key ingredients and what are the things to look out for in an initial raise. One of the things that comes up regularly is knowing your numbers, because the investors will expect people that enter the room with them to be absolutely clear on the journey and how it plays out, and they will challenge. So one of the things that we advocate is to finesse those numbers over a period of time. So it's not a problem to come up with a set of data that you have to change and adapt to individual investors' preferences. Because generally speaking, day one, as soon as you've got that initial tranche of investments, the plan changes anyway, because those are the vagaries of life. Things go off in different directions, but they will expect everybody to know their numbers.
And you should expect those numbers to be challenged as well.
Yes.
Oh, absolutely. With the state of the market at the moment, those numbers are consistently being challenged. Let's face it, we all try to push our valuation as high as we can. With the market the way it is at the moment, the VCs are pushing those valuations down, and you regularly hear conversations that say, well, this business is overvalued. You very soon find out what's happening. So, don't be afraid to ask the hard questions when you are speaking to investors. What are you seeing on the valuations? I'd love to be able to say valuations look like this at the moment. But, again, it's all about context.
Yes.
It's all about how much revenue you've got. I saw a deal recently in the States. It was an AI deal. I'll be honestly with you. I thought it was horrible. I didn't like it at all, but the founders were pretty amazing. I thought the idea was subpar, but the founders were absolutely amazing. And I think they raised 2 million literally over the course of a month.
Wow.
And this is at seed. So, shows what I know. So again, it's all about that context. I've seen other businesses that struggle to raise 500,000 because the numbers weren't there and a number of other factors. So, make sure that when you're telling the story, that the people that you're going to speak to will understand that story, and that you're able to articulate it.
Hi, Tim. Go on. You got a question?
Yeah. So for context, our business, we're established in New Zealand. Got about 15% market share. We've only got one customer just onboarding still for the UK, and we're planning on getting some growth and the UK as being one of our key growth markets offshore. How much traction do you need in a UK market, or how much market analysis and study from a trusted independent third party, or what do you need to do in order to give someone confidence for an entry, to get funding in the UK to help support an entry into the market?
The cheeky answer is as much as you can get.
Don't worry, I'm after that.
You're after that. Again, it's all about this. We keep talking about context, and the truth of the matter is, it depends on the investor's thesis. So, a smaller fund might be happy with some steady growth because you're obviously deployed in other countries before. But what they're really going to want to see is that you can take on your competitors within that market. So yes, revenue, traction, and all the rest of it. But you're still literally just landing. You're going after some new markets. So again, it goes back down to that risk mitigation piece. Who are my competitors, and how am I better than them? The one that I always hear is, you've got to show how you're 10x better than your lead competitor. And it's a truism. VCs tend to speak into cliches. I like VCs, by the way, just in case anybody gets hold of this recording. I love VCs. They're great people, great EQ. But sometimes they do speak in buzzwords. So yeah, as much as you can. But when you've just first arrived on the shore, I'd want to know how you're planning to, what that go-to-market strategy is, and how you're planning to take out your competitors. And then you then have those growth figures in the background to prove that that's what I'm doing. It's a slightly different conversation.
Yeah, I mean, Tim, that question was perfectly timed because we preach about traction. Coming into the market, investors that we've spoken to in the past, they really like international companies coming in because they're international, and that's great. But then they go, okay, back to risk. The risk is, who are they in this market, and who are they compared to their competitors that are here? And I think it's down to those two pathways that we talk about. It's sales and approaching investment. And if you can start to build traction and have a few partners here, or a couple of clients and a bit of a team, then you're de-risking yourself at the same time, and you become much, much more attractive. So, coming into the market cold and trying to raise, in our experience working with international companies, rarely works, unless, going back to Marco's point on context, you're a serial founder and it's an easy fit anyway. So
one of the things that sorry, just to add, it's the little things when you're coming in overseas that become challenging. So London, for example, if you try to get a place to live, and I know founders that have come over from overseas and have spent 6 months in Airbnbs and surfing sofas. We're running a successful business, but we're still sleeping on somebody's sofa because they can't get a place to live. You need to pay 6 months rent up front, and it's those little nuances to setting up in the UK where Simon, myself, and John can support you guys, where we can say, hey, you need to speak to somebody about getting a place to live, because trying to do calls off your mobile phone, is a challenge.
Yeah, I mean that's the thing about the ecosystem in London and across the UK. To be fair, everywhere's set up to support entrepreneurs and founders, so you will find a lot of support in that as well. And we live in a small country that's well connected, so you can be outside London and in London very quickly. So there's all sorts of options there for you.
Yep, no, look, that makes sense. It's it aligns with what I'm currently doing in terms of getting a few key channel partners, which will give us some good growth and traction and reference, and that will allow us to actually invest in coming in and hopefully raise in parallel with that. So that's good. Thank you.
Yeah, and don't forget the LOIs. As many of those as you can get is always good as proof within that data room.
Yep.
Brilliant.
So size of rounds, we were discussing this, and I was going to talk about this very, very briefly. Again, the reality is that VCs in a state of flux. I have seen VCs trialing new methods of generating a fund. So there was a discussion recently about a VC thinking that they can perhaps bootstrap a fund. VCs are very much like founders. They have to sell. What they buy are investments, but what they and what they sell is you. They sell you to their LPs, and being able to find great founders. That's their sales pitch. So it's been a bit of a state of flux. So you've got bootstrapping founders, VCs, should I say? You've got VCs that are looking to move away from the power law. So rather than 2 investments giving you 100x returns, you invest into 20, and 15 of those give you 3x returns. But as far as I can see, I think you will see that for the next 12 months. But then people are just going to go back to power law, because it's what makes sense, and it's a lot more interesting to talk about 2 amazing rapid growth businesses that have gone international within your portfolio than it is to say, well, this company did all right, because again, you've got to sell that to somebody else. But that's just my opinion, and I love power law, so I am biased. But some of the areas that we were discussing about that DD and some of the information that people are going to be asking you for, are those investor agreements that you've had previously? Who are your previous investors? We spoke about VCs not all being equal. So, if you've got some really good VCs, that will attract FOMO, and you'll get other people piling in and throwing money at you. In theory, it's never as easy as that, but that is where you should be having those conversations. Also, if you've had investment already, we're here to support you guys, and we very much believe in being open and honest. So I'm going to say this, which is contrary to what other people might say: go speak to your VCs. VCs hunt in packs. I'm part of the GM Investor Network. There's about 700 VCs on there. I'm part of a fintech investment group. There's about 200 VCs on there. We're all asking each other questions. What's happening within the market? What looks tasty? So VCs hunt in packs. VCs also have a network. So if you're a pre-seed investor, you're looking to sell to a Series A, Series B investor on your exit, or Series C if you're really good, and they want to go along the journey with you for longer. So speak to your investors. Who are their preferred people? Who have they got lined up to buy them out in the secondaries market? That's an important question to be asking of your investments. Funding rounds, again, we spoke about this just 5 minutes ago, so I'm not going to rehash that. But those preemption notices, those board resolutions, the shareholder resolutions, these are all common things that are asked when you're raising capital, especially at the later stage, because they expect you to be a real grown-up business. So have you guys got this in place? This is an interesting conversation. I think we should be opening up the floor here. This was my plan, was to open up the floor to you guys. Is, tell us about your business. Who wants to be brave and who wants to go first?
Should I pick on someone?
I'll go first.
Daniel's unmuted. Perfect.
Okay, come on, here we go.
I was faster. Sorry, guys. I jumped first because I will have to leave also at 10. Sorry for this. I'm from InvestBay. I'm founder, and we are building the property tokenization platform, which is concentrating on the recreation property across Europe. And we think that it's a good time for tokenization property, because the market has really changed, and the acceptance of the blockchain, it's already coming to the place. Also, the MiCA will coming into force. And we have a unique model how to do it, because as we are concentrating on the recreation property across Europe, we can offer our services across Europe as well, because we can offer, for example, the Spanish property for UK investors as well. It means that this is what we want to achieve it. Besides all of our products, we are taking care of all of the process. It means that we are finding the property, buying the property, operating the property, and finally sell the property. Our investor can invest from 100 euros. This is a minimum ticket. We have a 10 times bigger ticket in these days. We have some traction. And we also want to connecting in cooperation with the MasterCard, which we already signed a contract, the payment card, which will be connected to our investors' account. And our retail investor here will have a connection to their investment, what they have it. It means, and two things. There will be how much they're earning on that property, because we distribute all proceeds with them, and they can withdraw through the cards. And also we are preparing the way how to collateralize the tokens which our clients investing, and they can borrow some money in the between the part. Basically, this is what we are currently preparing, and we launch fully our product on the September this year. So far, we achieve just in the Czech Republic over 1,000 registered customers. We have 150 paid customers. It means investors. We have a growth rate 25% every week. Oh, every month. Sorry, every month. It will be nicer. And as I say, the average ticket, it's not a 100. It's 10 times. It's 1,100 euros, and we see the big potential for this one. And we are looking basically for money because we have a SaaS which is higher than the actual revenue from the tickets. Yeah, it means that the first year we pay off the SaaS, and then we have a SaaS 100 euros, and we can generate 750 euros over the time as LTV for our investors, because there is a repeatable expectation of the investment. Yeah, but sorry.
You're in an interesting space. So one of the predictions for as I said, for 2024 is a resurgence of blockchain. It's been slow. We don't speak about the other SAM, but it puts a lot of people off around tokenized products. So we're seeing that there's a prediction for that to be improved, and I'm sure. And you are all fintechs that the US recently just approved the use of Bitcoin within certain markets. So you're going to see more of that. Fintechs are, or should I say, cryptocurrency is a lot more readily acceptable. People are starting to get over the trauma of what happened. Although Binance has, also had a little blip with their CEO recently. So you're in a good space, but again, you've got to be able to share that traction and all the rest of that. So that's a really interesting space that you're in at the moment, and it looks to be a rapid growth one.
Yeah. I will ask if there will be possible make some consultation one-to-one. Yeah.
Yeah, sure. Please do.
Yeah. Because we see that exactly we have currently we are running the pre-seed round or some bridge investment for a while. We were onboarding some new investors for 100,000 euros in these days, which give us more product market fit. Yeah, to prove more ourselves and become maybe profitable in a 4-6 months operation in the Czech Republic. It means we need to fundraise for extending our services to UK and extended the services wider Europe.
Fantastic. I am going to open the floor up to just other people. So we are running. We've got about 9 minutes left on the call. So it'd be great to hear from some other brave people that would like to tell us about their business and what they're looking for and what the highlights of their journey has been so far.
Let's see. Who's next? Oh, Tim. Yes, go on. Tell us about
Tim.
I didn't even have to raise my hand that time. Well, for us, where we are at the moment is we've got a platform which provides training and compliance for regulated industries. So that in itself is not very exciting. There are lots and lots of compliance companies and compliance software out there. Nearly all of them are focusing on enterprise level software. And we've spoken to a number of compliance consultancy firms who are confirming that what they consider their small, medium enterprise customers are left without a viable solution. And we're filling that gap. It's enabled us to get 15% market share in New Zealand. And we expect that to grow very, very rapidly. We've got an exciting ecosystem strategy now where we've got the insurance companies and lenders putting all of their product accreditation training for their own internal compliance with the regulator on our platform. And it's created an ecosystem where the independent financial intermediaries, all through the one login, can access the accreditation from multiple suppliers and also have that recorded and provide it to the regulator. So we're getting some really good traction with all of that. And because the platform is not based on the regulation. It's based around the processes of demonstrating all of the regulatory compliance, very, very agnostic to, or very easy to apply to different industries and different jurisdictions. So for us, it's really like a lot of business where I think everyone is probably in a similar position. We need to invest more in sales. We've got the dev done. It's a mature product. We've got good revenues, but they're not great. The New Zealand financial services industry is still very small, in a country with only 5 million people. And for us, it's about scaling up and getting sales resource and investing. And that's what we've been raising in sort of small drabs of a couple of 100,000 here and a couple of 100,000 there. We had a VC fund that committed to give us $750,000, but failed to hit their threshold for their fund to coalesce, so we had it in writing subject to the closure of their fund, but in the current environment, they didn't close. So we've been through the ups and downs of it all. And really where we are at the moment is it's that longer runway so that we can confidently invest in additional sales resource.
Yeah. Really interesting that you talk about RegTech. RegTech is another one of those areas that's seen as being a growth area. Within the UK, there's been lots of different things that have been going on. So regulations, both within things like know your clients, anti-money laundering, but anything to do with regulatory, resolving regulatory issues or speeding up those regulatory issues or making that easier to manage is seen as something that is going to be a growing area, and the world's just getting a bit more complex each time. You've got regulations coming around AI. Finance has a plethora of regulatory things that need to be managed. So yeah, definitely something that's really interesting. And obviously you've got that 15% market share in New Zealand.
Yeah.
Out of interest, how have you achieved that growth? I mean, what's the playbooks that you've used to be able to achieve that growth?
A lot of hard work.
Okay.
But a lot of it's channel partner. So we got our initial success by finding the right compliance consultancy businesses. Well, Business One in particular really got us going. They use our platform as a master license effectively. And all of their clients sit on their own independent licenses, but in a hierarchical structure. So they develop their own compliance policies as templates as the consultant, and they act as a virtual compliance officer business. And so they can push everything down and look down into the compliance reporting of all of their client businesses. And that got us our initial traction. From there, we got reference customers. And then we went after some of the bigger aggregator groups for insurance, for example. And you get them at the right time where too many of the members of their group are still using Excel spreadsheets. You get the right pitch at the aggregator level, and that enabled us to scoop up 60% of that group. And then a lot of it, the rest of it is, we've got a few other, I suppose, ones in the pipeline like that. A few of them have tried to develop their own proprietary software. But anyone who doesn't have the deep pockets to try and do that, then we're the perfect solution. And I know that there will be other systems out there, but in New Zealand, we haven't come across anyone else with a platform that does what we do. Lots of other platforms do bits of it, and lots of other. We don't touch the client account record, so we're not a CRM for customer information. So that's where we've got some overlap with competitors who are the incumbent CRM who cover off some of our compliance solutions, but they certainly can't integrate with the supply chain.
Tim, there's 2,500 to maybe 2,800 insurance brokers in the UK. And 75% of them are owned by a small number of consolidators. So the model over here is the same where you are. And if you've got a convincing product, you could easily mop up a big chunk of your users in a couple of goes.
Yeah. It's just, I think the strength for us in New Zealand is that we were in financial services pretty unregulated up until a couple of years ago. So the regulations came in and there was a burning bridge. So everyone looked for a solution and we came to the market at the right time. And this is part of the market analysis, which I need to get done, but haven't got the time and resource. I haven't yet been able to do properly, is with the UK and the fact that regulations have been around for so much longer, how many of those consolidated businesses have had the financial wherewithal to develop their own systems?
Yeah.
But very, very few.
Oh, great. That's music to my ears.
Yeah, very few.
Brilliant.
So I was about to say we're running short on time, so I'm going to hand it back to Simon at this stage. And
yeah, I'm a bit conscious of time. I think in terms of next steps, I think if any of you guys have got teasers or short decks or any information, send them to me, and then I'll pass them on to Marco and John, and we can start getting conversations going. Because I think obviously this is such an interesting subject. And you know, Marco and John's knowledge is so good. It's just how do we get you into the right conversations at the right time? So that's what I want to do next, as soon as we can. Marco, thank you so much.
My pleasure.
Really, really good, really enlightening. John, thank you as well. I think you can all see this has been a great session. There'll be more to come. There's a sales session next week, and then one on tax and setting up your UK company as well. You know, like we always say, just feedback, any questions to myself or either Tony Hughes, and we'll be in touch with you for one-to-ones as well. So brilliant. John, Marco, do you want to hang on for a second and we'll just do a quick wash up? Yeah.
Simon,
Yeah.
I've got to go. I've got another
Oh,
call.
okay, cool. Well, I'll email you about doing a call, a little wash up in the weekend. Okay, cool.
Okay.
Brilliant.
Right.
Cheers all.
Thank you, everyone.
Thank you very much.
Thanks, guys.